Hi folks, John Grace back, President of Investors Advantage. We're now into part 3, and of course the Money Doctor is in, and we're looking at what happened during the Great Depression, because as we mentioned, if you look at what you have seen as part of your investment experience is 2000 and 2002, the first time your portfolio of investments, primarily equities, were off about 50%, and then again in 2008, the second time in the last 10 or 12 years you've seen your portfolios off 37 to 50%. The question is, were those warning signs, were those foreshadowing signals that we just said, it's okay, as long as I'm making money and I can continue to contribute to my accounts, I can get through this? Well, let's suppose that this is money that we're trying to live off of. It's a very different environment when it's money that we're trying to live off of. Certainly our perspective, the mood, our whole life changes dramatically. So where we left off, as you might recall, is we looked at 1928-29. It was a very good year, market on an upswing. And let's suppose that your account value, let's say around 1929, got to a level of roughly $1 million, and certainly that was a lot of money then. It's not as much now, but it's a number that people can relate to. And if we make it a little more real, we may find that those who have $1 million actually need $2 million to live off of, so that sometime in the next 5 or 10 years, they want this $1 million to double, let's say in a 10-year period. That is often reasonable, at least historically. And then we could have an income of, let's say, a 4% withdrawal off of $2 million, which of course would be $80,000 on an annual basis. That plus our pension and Social Security, for the most part, meets the conditions that people are trying to draw in their experience of maintaining a similar income in retirement as to a level that was equal to when they were working. In Thousand Oaks, the average household income, whether there's 1 or 2 people working, is about $100,000 a year. Across the country, like Ohio, the rest of the country, the average household income is approximately $50,000 a year. So clearly $100,000 is more than $50,000, but in terms of doing very well at $50,000 or $100,000 anywhere in this country, that's not exactly wealthy. I think we would all agree. So again, we got to a peak of $1 million. We need this dollar value to increase by 100% to get to $2 million, and then lo and behold, we see a surprising 40% drop. So now the $1 million, as you can see here, drops to $600,000. Then there's a good bounce in equities. The Dow Jones Industrial Average at the time about a gain of 29. So now that takes the value of $600,000 back to $774,000 approximately. And then in short order, there's a more significant decline that totals about an 86% drop in a total from peak to trough from 29 to 32, 33, a 90% drop. So what has been $1 million dropped to 600, bounced back up to 774, immediately becomes, or shortly becomes, a whopping $108,000. Now you need to sit with that a little bit, because clearly, as we say, you have a lot different discussion, conversations, lifestyle changes at $100,000 relative to $1 million. And again, we need this account to have doubled. So what we're saying is a couple things. One, yes, you did get back to even, but it only took you about 22 years for the $108,000 to get back to $1 million, assuming you didn't take any withdrawals. And remember again, we needed this $1 million to get to $2 million so that we could have an $80,000 withdrawal at a 4% withdrawal rate. Think of that as your speed limit in terms of the extraction level that you're taking money out. So maybe there is something to be learned, not in terms of stocks for the long haul or hold and hope. Maybe there needs to be more attention placed on being proactive from the standpoint of minimizing or limiting as much of that downside participation as we possibly can. In other words, it's not holding for the gains that might offset those losses. Suppose they're not coming. The question becomes, how do we become more defensive in a bad market? How do we take money off the table, let's say in a bad year like 2008? How can we learn where that might have been a possibility for us? And then how can we reapply the same strategy in reverse? 2009 was a very good year. How might we put the assets back on the table to participate in the gains that a very good market can afford us? Those will be the questions, and we'll be talking about that in our part 4. See you in a minute.